podcast with Investing Education Academy. So it finally happened. I caught COVID. So today's episode is going to be pretty short. I just found out today that I'm COVID-19 positive. So we are going to stay positive, but keep this short. You like what I did with that? Like that wordplay. All right. So Leon's going to tell you the topic we chose today while I do a little bit of housekeeping.
Yeah, so like I said, we'll keep it short so Brent can get back to resting. But so we chose what we're talking about today is called Dividend Aristocrats. And while that sounds complicated, while that sounds nerdy, all it means, all a Dividend Aristocrat is a company inside the S&P 500 that has increased their dividend at least once over the last 25 years. And the reason that's very impressive and very important is because remember, dividends are paid out from a company's profits. So
normally.
See, I got stop. See, yeah, that's what it's over, right? normally, dividends are paid out from a company's profits. Now, as Brent just pointed out, that's normally. Sometimes dividends are paid out. Companies will use leverage and borrow money to pay dividends. Those you want to stay away from. That's very, very dangerous. But typically dividends are paid out from a company's profits. The reason that's important is because if a company can raise its dividend for 25 years in a row, quarter of a century of raising dividends, and they're paid from profits, that shows you how profitable and stable the company is, right? So those are the type of companies we want to invest in, especially in this market. The reason we're talking about this today is because, again, we're trying to move everyone away from those high flyers we all were in the last 2 years that are now down anywhere from 40 to 80%, and move people into stocks that typically people invested in prior to COVID. Profitable, dividend payers, solid products, solid management, things like that. So Dividend Aristocrats are a great place to start. You can just Google Dividend Aristocrats. You can read about them and learn more about them. Now, one thing I also want to say is just because a company is a Dividend Aristocrat does not make it a good investment. Dividend Aristocrats are a good place to start your research, but you don't want to blindly invest in anything, whether it's what Brent and I say, whether it's what some guru online says, Jim Cramer, whatever. You never want to blindly invest in anything, and blindly investing in Dividend Aristocrats is not a good idea either. I'm gonna give you an example why. So many of us I'm gonna use myself. So many of us have heard of Stanley Black and Decker. Stanley Black and Decker. There was a company called Stanley, and there was a company called Black and Decker. They merged, and what this company does, they make a lot of the drills, hammers, saws, a lot of DIY equipment, things for working around the house, and they also have a commercial unit too. So Stanley Black and Decker, big company. I believe the company is, I think its market cap is either can't remember, it's either $7 billion or $15 billion market cap. So it's a big company. It's a mid to large cap company, and again, they've been paying their dividend. They've increased their dividend for the last 25 years, each and every year, quarter of a century raising dividends. That sounds great, right? All sounds awesome. Problem is, if you invested in Stanley Black and Decker 4 years ago, you would be down 26% on your money. So what I'm showing with that is showing that just because a company is a Dividend Aristocrat does not make it a good investment. It's a good place to start your research in companies, but don't just think, because they're a Dividend Aristocrat, they've increased their dividend 25. They've increased their dividend once, at least once over the past 25 years. I'm gonna automatically buy it. No, it's not a good idea. Like I said, Stanley Black and Decker, company that's been. I think the company's been around for 60, 70, 80 years. They've raised their dividend at least once over the last 25 years, or last quarter century. It has been a bad investment for the past 4 years. Now, if you go out longer term, possibly it's better. I didn't look. I was looking kind of in the medium term. The last 4 years, it's a 26% loser had you invested in it. So again, not saying that to scare you away from Dividend Aristocrats. I'm just saying that not all Dividend Aristocrats are good. You want to do your research. As we always say, do your research. But Dividend Aristocrats are a good place to start because we know that these are companies that actually have dividends. And the dividends they have dividends, and their profits are strong enough that they can actually pay out from those profits, typically, and they can do it for multiple years. Again, if you're a Dividend Aristocrat, if a company's a Dividend Aristocrat, it's been paying, it's increased its dividend at least once over the last 25 years, so quarter century. So,
hey, Leon, real quick. Mm-hmm. Some of you all are thinking, what do he mean by leveraging money to pay dividends. There are sometimes cases where a company may borrow money either through junk bonds or just loan from a bank or whatever means by which they take a loan out, but it's money that they owe to someone else. They then use that money and then they pay dividends. Why they do that sometimes is it may be to secure a position on an indices. Some indices have requirements, or it can be so they don't get delisted in some cases. And then other times they just want to look strong. They just want to look like they have a strong balance sheet because let's call it what it is. Most retail investors don't check. They just see a dividend and go, oh, dividend, it comes from profit, strong company. And we're saying that's not always the case. So even with the dividend aristocrats, pay attention to what you're investing in. Now, the reason we're bringing this up is because this market has been abysmal for most people. And if you got into the market, I'll say like November, December, January of last year, you're probably emotionally just tired. As this COVID has me tired. It was like this is like a lot to say just now. But the reason we're bringing this up is to bring some light into your portfolio. So when we do this, again, we have a community is thriving. Our community is doing very well. And we still go live every Wednesday to talk to you about the market. I just found out I had COVID today, still showing up to do this live with you all because we know there's pain out there. And we're not just saying, okay, well, everybody has to fend for themselves. And the reason I'm saying this in the middle of our podcast is because the information you're getting today, look it up, spend some time with it, think about it, ponder for a little while. Like, what does that mean? And then go do some research and see if it makes sense for your portfolio. Because these things have been saving Leon in our portfolio. I mean, we've done pretty well because we've been invested for a long time. But even during this time frame, we changed up our strategy. And now we're looking at these dividend aristocrats, and we're talking to you all about it today. So do something with the information.
Yeah, I mean, every week when we come live on this podcast, these are things that Brent and I have researched and things that we are doing. Some things we do, some things we don't do. Some things we don't do just because it doesn't fit our current situation, but we want to bring it to everybody else because it may fit your situation. Here's a perfect example. Dividend aristocrats, again, are a great place to start because remember, in this market is rewarding companies that have profits, not like EBITDA, not like just pure revenue, profits. So these companies that are paying these dividend aristocrats, remember they're S&P 500 companies, so they're part of the 500 biggest companies in the United States. They also pay a dividend, but as I just showed you, just because they fit that characteristics doesn't make them automatically a good investment. Stanley Black & Decker is an example. Again, if you invested in Stanley Black & Decker 4 years ago, you'd be down 26% on your money. There are many dividend aristocrats that are up a lot over the last 4 years. So you want to, like I said, you want to do your research. It's a good place to start, but never do anything blindly. And last point is that because we know research is hard, and this is what Brent and I do. So for the insiders and the in our community, in our membership community, for the insiders and Panthers, we're going to post two things. We're going to post one. There's actually an ETF that you can buy that invests in the dividend aristocrats. So you can just buy the ETF and you'll be fully invested in them. And then two, we're going to post another. We're going to post, from our perspective, the 5 best dividend aristocrats in the S&P 500. So we're going to post that either tomorrow or Friday for the IA Insiders and IA Portfolio Panthers this week.
Yeah, and Leon, we just got a comment that came in. It said, I just started last February, and I'm only down 8 or 9% when I took a look today. I'm going to consider that a win. Thank you both for the information you provide. Please don't consider that a win. Know that is a win.
Right, that's definitely a win.
And the reason why it is a win is because when the market recover, and the market will recover, you're going to be well positioned that you only have a slight bit of loss to gain before you enter positive territory. You're still going to, I don't know your portfolio, but you still have the probability of smashing what people are going to get in a bank account or a savings account because some people are liquidating and putting all their money in savings right now because they think it's better. And it's not. It feels better, but it's just fear. If you invest your portfolio the right way, and Leon and I have given you, go back to the podcast. We're not going to jump into it today. I am fatigued. But we've explained how you can take not necessarily a defensive position, but just in what we consider an appropriate position in this particular market. So I'm really, really glad to hear you say being down 8 or 9% is a win, because that means either you already had a great mentality, or maybe from listening to us, you developed that thicker skin. But that's absolutely correct, and you do have a win. Congratulations.
Yeah, because the S&P 500 alone right now is down about 15%. The Nasdaq,
you're beating the S&P 500.
Yeah, you're being the S&P 500. The Nasdaq is down closer to 20%. So as you said, an 8 to 9% is definitely a win. And as we said a couple of podcasts ago, the goal of this market is to lose the least. It's not really to make money, because this market, nothing's working, right? Stocks are down huge, bonds are down huge, so nothing's working, right? So you just want to find safe places to hide out in things like Dividend Aristocrats that pay decent dividends, just to kind of hide out while this turmoil goes on. And then we look for the bull run to start whenever it'll start. We don't know, but once it does, and it will, we just don't know when, but it will. But you want to be positioned properly in things like the Dividend Aristocrats. So like I said, it's a really good place to start looking. And again, IA insiders and IA portfolio Panthers, look out for this week. We're going to post the Dividend Aristocrat ETF, and then we're going to post Brent and I's top 5 Dividend Aristocrats. We're going to post it in the membership platform.
Yeah, and for the next comment came in and said, "You all keep me off the ledge and teach me the things I need to know to do better than I could on my own." And that's what the community is about, right? Investing Education Academy, the community of people, we post. There's a lot of posts going on inside the platforms, people commenting, but there's a lot of honesty. And unless you're honest about what you're trying to do, what you're trying to accomplish, Leon and I can't help. The community can't help. And so as you all continue to be honest, and also take a look at some of the stuff we're doing. Leon and I have absolutely told you all we have not been right with everything. We have not.
No.
But I'll tell you this, if you look at our portfolio, we are doing pretty okay. Now, with that being said, many of our members too, even in this down market, there's times where things hurt, and right now is one of them. But this is also a great time to position yourself for a very big win over the next 3 to 4 years. So, pay close attention to opportunities, because the market is on sale. It's not down, it's on sale. So what are you going to do? If you went to a store, and Leon always gives this analogy, and I used to bounce it, I used to ponder it, right? I heard him say it, and I was like, but now it kind of stuck to me. He would always say, why is the stock market the one place people don't want to buy things when they're down? He used to always talk about that. And I mean, when we were younger, he would talk, like a few years younger, he would talk about that. And it makes so much sense. We go into Costco, or our favorite retail shop would close, a grocery store, and our favorite things are half price. What do we normally do? Fill up half of our shopping cart with it and keep it moving. If we see our stock portfolio where it's down half, what do? We panic, run for the hills, and we dump everything out of our cart because we don't want it in there anymore. And I get it. It's that emotional factor that is my hard-earned money. I've saved it. I don't want to lose it all. While that is theoretically possible, it is generally impossible that you're going to lose everything if anybody loses every single thing in the stock market, and they had multiple stocks, not single stock risk, multiple stocks, then more than likely the end of the world is coming. And we have bigger problems to worry about than just
or they picked a bunch of penny stocks, a bunch of non-profitable companies. I mean, because like you showed before, you had a company that went to zero, right? So it is possible, but if you're in quality investments, companies like, again, Dividend Aristocrats, and as we showed, not all of them are perfect, but a company like Stanley Black & Decker, even though it's down 26% the last 4 years, it's not going to zero. Like, there is value there. It has cash, it has equipment, it has inventory. Like it investors would never let it go to zero. So yeah, things theoretically can go to zero. The probabilities of that happening in quality companies, pretty much zero. But again, these are the type of things you want to invest in now. Now.
Yeah. No more. Leon called me out. I'm just going to tell you what it was. It was Senior Providers Network. It was a real estate investment trust, and they were doing exactly what we're talking about. They were borrowing money to pay a ridiculous dividend. It was like 8-9% for like 5 years running. And I became so comfortable with the dividend payout, and I knew I wasn't looking for appreciation of the actual stock price, that I just stopped paying attention to it. And I never looked at the financials, which we always say, oh, you should look at the financials, know the financials. I wasn't looking. And the company started, like, went to like down 30%, 40%, 60%, 70%, 80%. This is just me being honest. I've been in the market so long. At that point, I had probably already been in the market 27 years. And I had never owned anything that went to zero. And so I just kept it to see if it really would go to zero. So at that point, I would have gotten out if I wanted to get out, could have gotten out. But I really wanted to say I've been through it all. And so I held it just to see if it went to zero, and it did. So I can legitimately say I have gone through it all. So I've had one stock have over a 900% rate of return. So it's all these things that exist in the market. So just be aware when you're diving into the Dividend Aristocrats, look at what your suitability is. Think about what makes sense for you and what can help you sleep at night.
Yep. And last point on Dividend Aristocrats as far as their returns. Again, use Stanley Black & Decker as an example, the one that's down. Because we always say, profits and revenue are the main thing that matter. Stocks go up. Well, they don't always, because Stanley Black & Decker, an example. But you have to remember, there are many, many, many variables that affect stocks. Revenue and profits are two of the main ones, but they're not the only ones, right? If a company misses its Wall Street estimates, stocks get hammered, as we see when companies report earnings and they miss. Today, these stocks are going down 10, 20% a day. Could have bad management. Product launch could have went bad. Like there's a multitude of things that affect a stock's value. So just because a company is profitable and has growing revenue, that's not the end all be all. You want, like we always say, do more research. Dividend Aristocrats are a great place to start. Don't buy blindly. Still, you do your research, but at least you're starting kind of ahead of the game because the companies are profitable with generally growing revenue. But you still got to do your research into them, and see what's actually getting positive returns and which aren't.
Yep. And so before we go, I wanted to make everybody aware that on our YouTube page, if you want to subscribe, Leon and I are entertaining the thought of putting some special content on our YouTube page that might not be available other places. So you will want to subscribe because it's probably going to be some good information. Of course, we're biased. But with that being said, check us out. Just search Investing Education Academy on YouTube. Subscribe to the platform. And we're trying to get our subscribers up. So we're trying to really grow Investing Education Academy going into 2023. So with that being said, if you are not a member yet, you can go to ianow.com to become a member. And we are going to put the information. Leon, you want to tell them again one more time what we're putting into the platform?
Yeah, so on Facebook, so we owe you, as Brent says, we owe you two things. We owe you two picks, either two stocks or two cryptos or stock and crypto. We owe you two picks. So one will be on our Facebook, in our Facebook group. So if you go to facebook.com and search Investing Education Academy, we'll pop up. You can join there. But then both picks will be on our membership community at IEAmembers.com. Both our picks will be there. And again, also later this week, we'll post there for the Insiders and Panthers the Dividend Aristocrats ETF, and then Brent and I's top 5 Dividend Aristocrats that we're picking out of that group.
Yep. Everybody, thank you for being with us. Thank you for enduring my lower voice today. But we'll be back next Wednesday to continue to be there for our community. Have a great day.